Pull a $20 bill out of your wallet and really look at it. It is a piece of paper. You can't eat it and you can't build a house with it. It only has value because we all agree it does. Since 1971, the dollar has been a fiat currency, meaning its value is based entirely on collective trust. Most of us grow up believing that when we hand that money to a bank, they lock it in a heavy steel vault with our name on it for safekeeping. In reality, cash sitting still is cash bleeding value. Every day those dollars sit in an account, the tax of inflation ensures they buy a little less than they did the day before. The number on your screen stays the same, but your purchasing power is quietly leaking away. Banks operate as massive lending machines. They require a constant stream of user deposits to keep the gears turning and the loans flowing. By treating a bank account like a secure safe, you are providing the fuel for a system that drains your personal wealth while generating record profits for the institution. Imagine depositing $1,000 today. The bank keeps a fraction, say $100, lending out the other $900. That money lands in a new bank, which keeps $90 and lends the rest. This loop repeats, creating thousands of brand new dollars. The bank pays you a fraction of a percent in interest for providing the fuel, then charges the borrower a much higher rate. They quietly pocket the difference, the spread, which amounts to billions in profit. This system relies on the constant movement of your deposits. It is a machine designed to generate wealth by utilizing the risk and the trust of the depositor. This lending machine scales all the way up to the top. When the federal government or a mega corporation needs to borrow more than any single bank can provide, they turn to the public. This is a United States savings bond. It is a giant official IOU. When you buy one, you are the bank. You lend the government your money in exchange for a promised return on a specific date. Managing this entire interconnected web is the Federal Reserve. As the bank for the banks, they act as the referee, setting the interest rates that dictate the speed of the entire economy. The Fed manages inflation. Imagine 10 people with one pizza. If everyone gets cash, the price skyrockets. To cool prices down, the Fed raises interest rates, making borrowing expensive and stabilizing the economy. When it's sluggish, they lower rates to hit the gas. The confusing financial headlines you see every day are simply reports on the Fed adjusting the valves of this money machine to keep the system from crashing. In the early 1900s, a banker named A.P. Gemini evaluated borrowers by looking at the calluses on their hands. He was measuring trust the old-fashioned way, focusing on character and hard work. Today, that human evaluation has been replaced by a mathematical grade, your credit score. A high score signals to the machine that you are a safe bet, unlocking cheap loans. A low score forces you to pay significantly more for the exact same car or home, effectively charging you a premium to participate in the economy. Your credit score is your digital reputation, and it dictates the price you pay to enter the financial machine. Within this single economy, people are playing by two very different sets of rules: the rulebook for the worker and the rulebook for the owner. The worker's rules focus on saving cash and waiting patiently, a strategy that guarantees your wealth is slowly drained by inflation. Owners apply the same mechanics the banks use. They use debt as a tool to acquire assets that grow faster than inflation, essentially creating their own spread between what they borrow and what they earn. The financial system operates on a complex set of instructions that are rarely handed to the public. Recognizing how money actually moves through the machine is the first step toward making those rules work for you, rather than just working for the system your entire life.